welcome to the Monday Futures Market Outlook for April 29th, 2013. This is Patrick Ceresna. First off, I want to take a look at that U.S. dollar index futures, and we were looking for a bullish breakout to the upside to potentially occur. We were emphasizing that the need for that to be driven by a euro drop below the 130 level was a necessary part of the whole process. At this stage, the euro continues to hold up, and other currencies remain relatively stable. So the U.S. dollar is coming off those highs. At this juncture, very much any bullish scenario for the U.S. dollar involves the breakdown of the euro, and so we're going to be watching that euro for the signal that the U.S. dollar could have that breakout up towards the 85 level. So next here we have a chart of that euro futures contract, and the euro continues to kind of stay within this 131 range. If we don't have that breakdown move here, we could easily come back for a full retest of the 132.50 area, maybe even go even as high as the 134 on the short term if there was strength. And it's not necessarily something we're anticipating, but there is the potential for that. Ultimately, we do believe the euro has another big round of selling coming, but it's all an issue of whether it comes here in the month of May or whether a push higher on the euro makes it more of a late June or July story on the other side of it. And so we're going to continue to watch for signals, obviously, this week with Draghi speaking later this week. There's going to maybe be an input variable that could begin that next trend. Next year, when we take a look at the 30-year Treasury bond, the bonds continue to edge higher toward the top end of their ranges. While this should act like an overhead resistance level, there actually is a chance that Treasury bonds may break to higher highs, as we've already seen that with 10 years. Treasuries, the 30 years, are just simply lagging a little bit. Really, at this stage, any breakout on the upside of this 30-year really does leave room for all the way up to like 154, 155 on the upside, but that would be really a 3 to 6 month trend, and not necessarily something that would be a 1 or 2 week kind of trade. At this stage, we think that overhead resistance will cause the Treasury bond to at least stall out there at those moments, as we kind of probably need to consolidate before a breakout move is engaged. Next year, I want to take a look at copper futures, and copper remains relatively weak. We've certainly found a short-term low that has allowed a bounce. The bounce on copper could easily work its way back up to the 335 level, where all the lows came in June, July, August. Off that level, though, that's where we're going to get a very big tell from copper, whether or not there's another leg lower coming or whether this is where the bottom of copper is. We'll find out over the upcoming weeks, but certainly the most aggressive selling has now subsided. Next year, we're going to take a look at crude oil. Crude has found a short-term low around the 87 level, and it's kind of found its way right into the middle of the sideways range-bound zone. Really, at this stage, we have a relatively neutral outlook on oil. There is room for it to easily gravitate down to 87, and under the right circumstances, it could even drop as low as the 80 level, where the lows of last summer were. But beyond some short-term volatility in those ways, we are really do consider crude oil to be far more a range-bound commodity, and probably you could buy on dip on weakness back down to the bottom end of these ranges. Next year, I want to take a look at gold futures, and gold had that substantial route to the downside that really, at this stage, has solidified its short-term low. We've now are well over $120 off of the low prints off of last week, and so really at this stage, this bounce probably will start to taper out towards 1500 or so. At some stage, we do expect there to be what we call a key bottom retest. It doesn't have to go all the way back down to its previous low, but just something that there'll probably be some distribution, and then we're going to see whether the buy on dip traders will hold it at a higher high. If that happens, then we could start looking at the scenario that gold can really stay far more range bound to even start to strengthen even further later in the upcoming months. But at this stage, chasing this one higher here this week is probably going to get you caught in a little bit of a throwback, so focus more on a buy on dip on golds. Finally, I want to take a look at the S&P 500, which very impressively has worked its way back up to its previous highs. We've had all sorts of technical evidence to suggest that a market correction should be well underway, and yet the S&P manages to hold up so relentlessly up along the highs. This is a very dangerous moment in the market because a key top retest like a double top can very much reject off of this zone. And while we don't necessarily suggest that that's a certainty, really this is the point where the market is most vulnerable to it, and so we're going to be watching whether or not the bulls can actually muster up any follow through, or whether this is where selling comes in. We still believe that even though there's room for the market to be bullish right through the summer, we do expect there to be somewhere a throwback, some sort of a 3 to 6 week market correction that will be a buy on dip opportunity, but really at this stage the market has yet to give anything like that. So we're going to be watching how it continues to behave up along here. We'll watch where and what could cause a market correction to develop. Even if there is a short-term breakout, we could maybe see 1600 or 1620 on the upside, but really the really good risk-reward proposition will come on buying dips. Just to make some key intermarket observations, we think that the risk-reward proposition on both the U.S. dollar and bonds remain good. We're still a little bit cautious on commodities, as we want to first know for a fact that the bottoms have been solidified in order to start looking at them from a good risk-reward proposition. As for the U.S. stocks and global stocks, we remain of a poor risk-reward proposition on the short term. Even though they are trending higher or range-bound, we do believe that they have to still stabilize and go through some sort of a corrective step back in order for us to look at them as a buy low opportunity. That was your Monday Futures Market Outlook. Thank you for joining me.